Markets continue to drop, and inflation is at its all-time high. There is indeed a ton of uncertainty for the future of the world economy. Today, we will hear Cathie Wood's assessment and her opinions on the actions of the Federal Reserve. Stick around to the end of this video to understand what Cathie thinks is bound to happen to our economies. Since the recovery following COVID, the economy has been steadily picking up steam, yet numerous economists and other professionals have been sounding the alarm about an impending economic downturn. The Fed's recent quantitative contraction has confirmed these worries. Cathie Wood, the CEO and Chief Investment Officer of ARK Invest, has revealed that she is concerned about the economic shocks. Nevertheless, she has been questioning the Fed's responsive efforts to cool down the hot economy. While on an episode of In the Know, she discussed current economic challenges, including the role of the Federal Reserve. Experts like Elon Musk of Tesla, JP Morgan CEO Jamie Dimon, and David Solomon of Goldman Sachs have expressed similar concerns concerning possible economic slowdowns. Cathie stated that the Federal Reserve would be making a grave error if it decided to raise interest rates when the yield curve was inverting. New levels of inversion have been reached in the US government bond yield following recent vital employment data, which increased the odds that the central bank will raise interest rates more than expected. Since 2007, this is the first time that the 2-year rate has been higher than the 30-year rate, whereas other curve components, such as the 5-year and 30-year segments, have already inverted. According to her, the Fed's potential interest rate hike is like playing with fire. Because of this, it is crucial to consider her point of view since the Federal Reserve has openly signaled its intention to implement another interest rate hike, which Cathie believes would have significant repercussions for the economy.
Okay, on to the economy. Well, we've had some very interesting comments on the economy by business leaders. Just yesterday, I believe, Elon Musk said that he has a super bad feeling about the economy. Jamie Dimon at JP Morgan talked about a hurricane. Be prepared for a hurricane. He doesn't know what kind of hurricane. Is it going to be a mild one, or is it going to be a Hurricane Sandy, which would be quite serious? The president of Goldman described this environment as a confluence of shocks that in his career has been unprecedented. So again, he has a very good perspective, global perspective, every sector. And so I would say at the margin, these three business leaders are seeing the economy in some form of stress. Markets, what are the markets telling us? Equities are telling us that the Fed is going to make a mistake. And even the Fed is saying we could make a mistake. The economy could enter into recession. We hope not. There are instances of so-called soft landings, but I would submit that housing and autos down 20% is not a soft landing. You're seeing in the sectors, as equities are broken out by something called GICS sectors, energy, utilities, and materials are up. Now, energy and materials are value sectors, and they tend to do well in inflationary times. If we're right and fiscal and monetary policy are both very tight and getting tighter, then at some point this is going to flip. We will flip away from this value rotation and back to growth, and it couldn't happen too soon for us, of course. On the losing side, consumer discretionary, and of course any advertising sensitive company is getting hit here, especially on the social side, and especially with the competition from TikTok. So it's hard to tell how much of this is a competitive dynamic and how much of it is an economic dynamic. It's probably both. And of course, technology has been an underperformer. Interest rates, interestingly, as the Fed has talked in a very hawkish way, meaning it will continue to tighten. The long-term Treasury yield has had trouble getting and staying above 3%. Now, in my mind, 3% Treasury yield would be consistent. See, this is the 10-year Treasury bond yield. It would be consistent with 10 years of 3 to 4% nominal GDP growth on average. So right there, unless the economy is negative, it's very unlikely, meaning economic growth, real economic growth is negative. It's very unlikely that inflation is going to be in the 3 to 4% range. So that should be reassuring to the Fed, and the yield curve, meaning the difference between long-term Treasury yields and short-term Treasury yields, that has flattened dramatically. In other words, as short rates have gone up following the Fed and anticipating the Fed, if we're thinking about the 2-year rate, the 10-year rate has not gone up that much. And so the yield curve has flattened to roughly 30 basis points, or 0.3%. That's a very flat curve. And it is typically associated either with disappointing growth impending, or lower than expected inflation, or both. And we think it will be both. And we do believe that the Fed in these next few months is going to get the message loud and clear that it cannot increase interest rates much more than it already has. We probably will see the other 50 basis points here in June. But by July, as companies are reporting earnings and talking about the future, we think the Fed will get the message. And this will be very positive for the equity markets. And this is what we're waiting for. As I always say, dark is before the dawn. We're in the bear market. Everybody knows what the problems are. And we're beginning to get signals from the marketplace that the Fed is probably going to at least start talking in a more dovish way, as opposed to hawkish. We see the dollar and junk bonds and credit default swaps, all of them kind of swinging wildly in the last month, not giving us any sense of direction. We've seen commodity prices, as I mentioned, oil going back up, but not getting back to where we were when Russia invaded Ukraine. Remember, at that time, many people were expecting oil prices to go to $200 a barrel based on that supply shock, and that did not happen. So we're waiting here. I often use the word Wile E. Coyote, or the idea of Wile E. Coyote, running and running off the cliff, not realizing it until he looks down, and then boom. This reminds me very much of 1986. Yes, I did say 1986. Oil prices were stubborn, levitating. And, the cartel even had more power back then. And it levitated until it was clear that demand destruction was not going to allow for the pumping of oil at the rate OPEC and others were pumping it. I think the same thing is going to happen now, especially now that the U.S. Or oil producers can hide behind national security as they are starting to pump more oil. I think within the next year, we'll be up to an all-time high in oil production again, and we'll be perhaps we'll be the largest producer in the world once again.
What do you guys think of Cathie Wood's perspective? Do you agree with the actions of the Federal Reserve? Comment your thoughts in the comment section below, and check out our previous videos on Cathie Wood. See you in the next one.